Hello, everybody. This is Sunko, the Korean bro. Today is 2023, October 29th. And let's see. Okay. Okay. If you had invested $10,000 in Apple when the iPhone came out, this is how much you would have today. Apple's iPhone has generated more than $1 trillion of revenue in its history. The iPhone sales have grown gradually and steadily over the years. The Take Titan is set to debut another transformative device early next year. There's no question that Apple's iPhone has changed the world. The device, which was the first touchscreen-based smartphone, ushered in the mobile computing era. At this point, it's responsible for well more than $1 trillion in revenue for Apple and with high margins. From a business perspective, the iPhone is one of the most successful products in history, and 16 years later, it still underpins Apple tech empire today. The smartphone is bolstered by complementary devices like AirPods and the Apple Watch, as well as the services business, which has driven much of the company's profit growth in recent years. To give a sense of how transformative the iPhone has been for Apple, the chart below shows how the stock has done since its iconic smartphone was released. With a return of 3,830%, if you had invested $10,000 in Apple on June 29, 2007, you would have with dividends reinvested, the figure would improve to this life-changing result from a one investment, and Apple's gain since the debut of the iPhone offers a number of lessons for investors. Breakthrough product can produce transformative returns. It would have been hard to know how successful the iPhone would go on to be when it was first released, but there were some clues. Becoming the de facto MP3 player, as a result, Apple's new phone was highly anticipated. Once it came out, assured users largely raved about it at the time. It was evident that the iPhone was something new, combining much of the utility of a computer with the portability and convenience of a cell phone. Additionally, there was plenty of hype heading into its release. Predicting its future revenue and profits would have been impossible, but some of the signs of its success seem clear in retrospect. As an investor, it can be easy to overthink things, but sometimes a seemingly obvious choice is the right one. If you see a product that looks like it could be a big success in investing, the parent company could be a winning move. It would take a few years for a tech stock to consistently move higher following the release of the iPhone, which was partly due to the impact of the financial crisis and stock market crash. However, it would also take years for the iPhone to become Apple's biggest product and therefore move the needle on the bottom line. In other words, to invest Apple successfully back then, you needed to have the foresight to see how impactful the iPhone could be, but also the patience to wait out the volatility as the device gained momentum. Apple is set to have another big product release, arguably its biggest since the iPhone, early next year when the Vision Pro goes on sale. The Mac maker introduced its new special computing headset back in June as its developer conference. It will sport a price tag of $3,500. At this point, it's unclear how the Vision Pro will fare with the general public because no one has tried the device yet. However, it does have the potential to kick off next generation of computing, similar to how the iPhone heralded the smart start of the mobile computing era. Hmm. The major difference, between Apple today and Apple in 2007, when the iPhone came out, is its size. Today, the company has a market capitalization of nearly $3 trillion, while it was just a fraction of the size in 2007, at roughly $100 billion. That means it will be much more difficult for a single product to have the kind of impact the iPhone did. However, investors will want to pay attention to the early response to the Vision Pro since the new device certainly has the potential to move the stock. It just won't turn $10,000 to $383,000 the way that the iPhone did. You know. Okay. To dividend, here's one stock that Warren Buffett, Bill Ackman, and Kathy Wood all own, and why you should consider owning it too. Alphabet is the lone common denominator in Buffett's, Ackman's, Wood portfolios. The reason why these three famous investors own the stock vary. The reason is that often makes the stock's valuation even more attractive. Warren Buffett, Bill Ackman, and Kathy Wood aren't exactly the three musketeers. They've all achieved tremendous success through the years. However, they've taken significantly different paths. There's very little overlap between three famous investors' portfolios, but that doesn't mean there isn't any common denominator. Here's the one stock that Buffett, Ackman, and Wood all own, and why you should consider owning it too. Three for three. Ackman's Pershing Square capital management portfolio only included 8 stocks as of the end of the second quarter of 2023. Wood's various R Invest ETF traded fund owned more than 120 stocks. Alphabet ranks as the 12th largest holding for her autonomous technology and robotics ETF. You won't find Alphabet in Buffett's Berkshire Hathaway portfolio, even though the legendary investor has expressed regret for not buying the stock in the past. But Buffett nonetheless owns a stake in Alphabet. Um, Way back in 1998, Berkshire acquired General Lee. Um, 3 years earlier, General Lee acquired New England Asset Management. As of the end of quarter second, New England Asset Management owned uh, 30,400 shares of Alphabet. Any stock in Neem's portfolio is by default a Buffett stock, albeit indirectly. I should note that there's one small asterisk here. While Altman owns both Alphabet Class A and Class C shares, Buffett only owns Class A shares and Wood only owns the Class C shares. Technically, all three investors don't own the same stock ticker, but they do own shares of the same company. So why do Buffett, Altman, Wood like Alphabet? Altman's reasoning is the easiest to determine because he explained exactly why he invested in the company at the CNBC Delivering Alpha conference in September 2023. The hedge fund manager told CNBC's Scott Wapner that he initially bought Alphabet stock earlier this year because it was cheap. Altman was also confident about the company's long-term prospect in the artificial intelligence space. He stated that Google will be a dominant player in AI for the very, very long term. Interestingly, Wood isn't as big of a fan of Alphabet as you might think. Hmm. She told an audience that OpenAI ChatGPT is going to cause a lot of problems for Google. However, it's not too hard to figure out why two of Wood's ETF own significant stakes in Alphabet. Wood is really bullish about self-driving cars and space innovation. Alphabet's Waymo unit is one of the handful of leaders in autonomous vehicle technology. Google Ventures has invested in several space-related businesses through the years, including Spin Launch, which is developing kinetic space launch systems. As far as I know, Nemes Management hasn't publicly disclosed exactly why they invested in Alphabet. But Buffett acknowledged in the past that he thought the company had a great advertising business. Hmm. Why you should consider owning Alphabet stock too? I think that you should consider owning Alphabet stock too because of the same reasons Buffett, Altman would own it. It's cheap. The company will continue to be a leader in AI. Alphabet is investing in multiple game-changing technologies, and it's a giant in the advertising market. Sure, skeptics will raise questions about the company. They'll argue that Google Cloud's growth rate is slowing. They'll suggest that OpenAI and Microsoft are beating Google in AI. Some will even claim that AI represents an existential threat to Google search. My view is that those objections will fall by the wayside one by one over time. I expect that Google Cloud's growth will reaccelerate when Google's new Gemini generative AI models are launched in 2024. Gemini is reportedly already 5 times more powerful than GPT-4. Google search is more likely to be enhanced rather than jeopardized by AI. But three of the world's most well-known investors only agree on one stock. Chances are that it's a good one. Meta platforms. The fourth dominant growth stock you're going to buy in the wake of the Nasdaq bear market is Alphabet, the parent of internet search engine Google, streaming platform YouTube, and autonomous driving company Waymo, among other ventures. Although Wall Street wasn't thrilled with Alphabet's slowing growth from its cloud shaman, the no-brainer competitive edge Alphabet brings to the table is its world-leading internet search engine. The no-brainer competitive edge Alphabet brings to the table. Google accounted for nearly 92% of worldwide search share in September. Mm. And it hasn't tailed last 90% of global search in any given month since the first quarter of 2015. As the undisputed go-to for advertisers, Google is going to command exceptional ad pricing power most of the time. However, Alphabet's cloud shipments should be an even bigger growth driver for the company, despite producing only 22.5% year-over-year sales growth in the third quarter. Google Cloud is the worldwide number 3 in cloud infrastructure service spending. Enterprise cloud spending is still in its very early innings, which should yield a long runway of double-digit sales growth. To boot, Google Cloud has been profitable for 3 consecutive quarters following years of operating losses. YouTube is another auxiliary operating segment that's a key cog in Alphabet's long-term growth. It's the second most visited website in the world behind Facebook and has seen shorts rapidly grow in popularity. Daily views of sports have surged from a 6.5 billion to more than 50 billion in just 2 years, representing a surefire opportunity for YouTube, bolster its advertising revenue and pricing power. Similar to Facebook, Alphabet is historically expensive. Following the drubbing it took last week, shares of the company can be purchased for approximately 13 times for the year cash flow. It's below the multiple of 18 times the year and cash flow the shares have averaged over the previous 5 years. Alphabet, like Meta and other dominant businesses on this list, is a screaming bargain. Okay, while most companies have difficulty making a debt in a single business, Amazon has proven its mettle by leading two industries. It strengthens in these markets, combined with its emerging opportunities, could propel Amazon stock to new heights. During last year's period of high inflation and rising interest rates, consumer spending was hit hard. But inflation has dropped significantly, and pundits now see the potential for the Federal Reserve to cut interest rates again, both factors that are surprising, spurring a rebound. This will no doubt benefit Amazon in its position as the undisputed leader of e-commerce. In 2022, Amazon was responsible for roughly 38% of online sales in the US, more than the next 14 digital retailers combined, according to data provider Statista. As consumers increase their discretionary spending online, Amazon will reap the rewards. The digital transformation is spurring greater adoption of cloud computing, um, another area where Amazon shines. Despite rising competition, Amazon Web Services remains the top cloud infrastructure services provider with 30% of the market, according to data provider Canalys. The company cloud could maintain or even extend that lead with an assist from the accelerating adoption of generative AI support for which the company is already offering to its cloud customers. Despite its rubbish gains so far this year, Wall Street is still incredibly bullish on Amazon. Among the 53 analysts covering Amazon, the stock has a median price target of $170. They suggest potential upside for investors of 36% over the coming year compared to the stock's closing price on Friday. Furthermore, in September, of the 53 analysts who had issued opinions, 51 rated it a buy or strong buy. Not a single one recommended selling. Part of the attraction is Amazon's historically low valuation. The stock is currently selling for two times next year's expected sales. Near its lowest valuation since 2016. That's even more incentive for investors to buy Amazon stock hand over fist and hold on to it for a long term. One of the biggest catalysts that has spurred the stock market recovery this year is the rapid and accelerating adoption of generative AI, and arguably no company is better positioned to profit from this trend than Nvidia. The company's state-of-the-art graphic processing units technology, originally developed to generate high-quality images in video games, have also become the gold standard for powering cloud computing and AI systems. As businesses of all sizes scramble to join the AI gold rush, NVIDIA has experienced an unprecedented surge in demand. company's recent results caught even the most bullish on Wall Street by surprise. For its fiscal 2024 second quarter, Nvidia's revenue grew 101% year over year to a record $13.5 billion, while its diluted earnings per share soared 854% to $2.48. Driving those results was data center revenue that soared 171%, spurred on by demand for hardware to power generative AI. It's important to address the elephant in the room, Nvidia's lofty valuation. The stock is currently selling for 40 times for earnings and 13 times for sales. While Nvidia's valuation is certainly steep, the company's growth deserves premium valuation. While its revenue has increased 123% so far this year, its profit have soared 335%, causing its price to earnings uh, ratio to constrain its valuation to fall. Further contraction is likely as the demand for AI continues to soar, pushing its earnings even higher. Okay, now let's go over to articles posted uh, in each website. Okay. Hmm. Okay. Amazon announces its first automated US fulfillment center to eliminate plastic delivery packaging. This is part of a multi-year effort to convert US fulfillment centers to a paper a transition that will allow many customers to recycle at home. Our highly automated Amazon fulfillment center in Ellucid, Ohio, is the first in the US to replace plastic delivery packaging with paper packaging solutions that are capable, hmm, that are capable of that are curbside recyclable. Like most retailers, Amazon has traditionally used a mix of plastic and a paper packaging to optimize for durability, weight, and size. However, recycling plastic packaging generally requires customers to head to a drop-off location. So our packaging engineers have been researching and experimenting for years to ensure we find the right solutions to deliver products to customers with paper. Plastic packaging generally requires customers to head to a drop-off location, so our packaging engineers have been researching and experimenting for years to ensure we find the right solutions to deliver products to customers with paper. Right solutions to deliver products to customers with paper. By rebuilding existing machines to use paper instead of plastic, creating durable and flexible paper packaging, improving made to fit technology, and transitioning from plastic air plugs to paper folder The team enabled the Lucid Fulfillment Center to transition fully to paper packaging. This work is part of a multi-year effort to convert U.S. fulfillment centers to paper. These new paper solutions will provide the convenience of allowing many customers to recycle at home. This is a major milestone for our U.S. fulfillment centers. I'm incredibly proud of the teams that develop new technologies to eliminate plastic packaging. This is just the beginning as we continue to discover more ways to eliminate reduced plastic packaging for our customers. Here's a look at the innovative solutions our packaging engineers created to eliminate plastic delivery packaging at Lucid Fulfillment. Okay, it's getting a bit long and getting a bit tired because today I had a really rough day. So I'm gonna see you tomorrow and happy Sunday night. Okay, see you and have a good night. Bye bye.